What's the one thing everyone wants to know when they're thinking about buying a home? Surprisingly, it's not will my partner let me paint the bathroom pink, but it is often how much can I borrow? That magic figure is your borrowing capacity, the key to making your next big ambition happen. But how is this number decided? Picture this. The lender's assessment is essentially a big game of financial Jenga. On one side, you have everything that builds your financial tower up. On the other, you have everything that pulls your little blocks out, reducing the stability and size of your tower. The goal is to have your tower solid and sky high. The first and most obvious piece is your income. This could be your salary, bonuses, commissions, or even that sweet rental income, if applicable. The more you have coming in, or the bigger the piece, the more solid the foundation, like a sturdy table for your finances. Next up is the size of your deposit, or the equity that you have in an existing property. The bigger that amount is, the less risk the lender is taking on, and the higher they're willing to let that Jenga tower go, knowing that if a piece is pulled out, less pieces will fall. And for the self-employed stars out there, you already juggle more clubs than a circus clown. But the cleaner and clearer your financial records are, the faster the lending process is powered through. To return to our Jenga analogy, clear financial records help the lender see a sturdier base that can hold a higher tower. Now, time to meet the opposition. The things that start threatening to pull the blocks out of your borrowing power Jenga tower. Every regular payment that a borrower has counts against their borrowing power tower. This includes personal loans and car loans, and even that buy now, pay later account. But here's where things get sneaky. The pocket-sized villain, the credit card. Even if you're a super responsible adult who clears your credit cards every month, never misses bin day, and hangs out your laundry to dry instead of rushing it into the dryer at the last minute, any credit card will still count against your borrowing capacity. It turns out, lenders don't care about bins and laundry, but really care about your credit card limit, not just the amount owing on it. Any credit card could cost your borrowing capacity up to 5 or 6 times its limit. It can be the deadly enemy of borrowing capacity, just like your uncle getting cranky and flipping the Jenga table. And if there are dependents, they're a factor too. Lenders have to account for the financial cost of supporting them, so the more tiny humans there are running around, the less money you have available to use for repayments. Here's the most important piece of expert advice. Just because a lender says you can borrow a certain amount doesn't mean you should. The higher your Jenga tower goes on the same foundation, the less stable it is. Borrowing capacity is the lender's comfort limit, not necessarily your comfort limit. It's better to not be living on a permanent diet of 2-minute noodles, which, while delicious in the short term, is not something you want to live off forever. Work out what repayments are comfortable for you, and then factor in a decent buffer. This ensures that you can handle rate rises or unexpected expenses without feeling the squeeze, and without letting your Jenga tower topple. Remember, borrowing capacity isn't set in stone. Different lenders will offer a different limit, and you can improve your capacity in a number of ways. It is a good idea to consider clearing or significantly reducing credit card limits, consolidating any high-interest loans, and keeping on top of your savings and budget. If you're considering changing the industry you're employed in or taking on a lower salary, it's important to talk to a loan market broker because consistency is king. Speak to a loan market broker today to get an accurate read on your borrowing capacity and set up a rock-solid Jenga tower.
Loan Market. Make it yours.